This amplifies everything. When investors get spooked, they can now instantly buy gold exposure, translating market fear directly into upward price pressure. Which brings us to the single most important long-term driver of this whole meltdown: the United States government itself. Let's look at the receipts. The modern era of gold pricing began in 1971 when Nixon formally severed the dollar's last link to gold. From that moment, the national debt went supernova. It exploded from a quaint $400 billion, less than 40% of GDP, to a mind-bending $10 trillion in 2008, and now a catastrophic $37.5 trillion in 2025, representing roughly 124% of the entire U.S. economy. That's not a line on a chart. That's a national death spiral. So what if I told you that death spiral is directly wired to the price of gold? Here's the cheat code: 92%. That's the statistical correlation between U.S. national debt and the price of gold since 1971. This isn't a coincidence, it's causal. Gold is acting as a barometer for America's fiscal sanity, or rather its complete lack thereof. As the debt rises, global confidence in the dollar's long-term purchasing power systematically dies. And that capital flees directly into gold for survival. This creates the ultimate policy paradox. The U.S. government is trapped in a corner it built for itself. The very actions they take to stimulate the heavily indebted domestic economy, printing money, cutting interest rates, deficit spending, are the exact things that murder the dollar's value on the world stage and bolster gold's status as its only real monetary competitor. The medicine is the poison. But no asset goes vertical forever. The market is now technically overbought.